Many of us investors invest regularly to maintain our lifestyle when we retire. Naturally, we might wonder whether P2P lending is a suitable investment option in the long run, which I will be covering today. This video is split into two sections. First, we will discuss what's required to retire with P2P lending, then elaborate on whether it's a reliable strategy. So let's say you are 30 years old today and need €2,500 every month to sustain your lifestyle. Assuming a 3% average inflation rate over the next 30 years, you will need around €6,000 per month in 2053. If you were to live purely out of the interest from P2P loans, you would need around €800,000 in P2P loans in 30 years that generate a 9% interest rate.
You can achieve this with an initial deposit of €48,000 and a monthly contribution of €100. From a mathematical perspective, this is reasonably achievable. Let's make the calculation more realistic and say that you need to pay 25% tax on your earnings yearly. In that case, you would need to start with an initial amount of €66,000. Still, the compounding effect and the monthly contribution will help you achieve your target if we assume a stable 9% annual yield. You can take an even more conservative approach and expect only a 5% interest rate over the next 30 years. In that case, you must deposit €210,000 to reach the target if we consider a €100 monthly contribution, regular tax payments, and a continuous yield of 5% per year after we retire in 30 years.
You can use our compounding interest calculator on P2P Empire to fine-tune your individual calculation. The biggest question now is whether we can rely on this prediction. P2P lending is a relatively new asset class, so the historical data is limited. One of Europe's first peer-to-peer lending platforms was Zopa, which started operating in the UK in 2005, less than 20 years ago. Today, Zopa is a regulated bank that offers around 4% annual interest rate on fixed deposits. I am unaware of the type of rates Zopa offered 18 years ago, but our assumptions of a 9% fixed rate would not be met if we used this data to calculate the future yield. Zopa is also just one example of a peer-to-peer lending platform. Many other platforms such as Bondora or Funding Circle operate today. Some platforms use retail investors to fund their portfolios, others use institutional funding instead. As you can see, you can expect the product to change over the years. Either the interest rates decrease or the platform stops offering investments for retail investors as they find cheaper funding elsewhere. Although this makes our initial calculation unreliable, decreasing the rates over the time is actually a better scenario. Plenty of platforms shut down and stole millions from retail investors. While avoiding scams is somewhat easier with projects like P2P Empire, there is still a risk that specific platforms will shut down their operations, and if you don't monitor the environment, chances are that you lose some money as well. There are still too many shady platforms operated by fraudsters. You can watch my video about the dark side of P2P lending for more information. Unfortunately, no one will protect your funds if you invest in P2P lending platforms. And to be honest with you, many P2P lending platforms need to be helping to improve the industry. If you're watching my monthly performance updates, you are aware of platforms that seek funding without providing performance-oriented data, making risk evaluations for investors challenging. Those platforms target less educated investors who prefer to see the highest interest rates rather than real insights into the platform's risk management. On the other hand, we have a few players that publish performance-oriented data, which gives you a good idea about the platform's risk appetite, which is crucial when investing in loans. What we also have to consider is the change in the market environment. As most platforms fund loans worldwide, they are also impacted by various regulations and geopolitical events. This increases the risk and limits the liquidity of your investments, which is not good if you plan to live off the interest when you retire. While we cannot predict future economic cycles, we shall also not be naive and think that there won't be any volatility. Those are the factors we shall consider when planning to rely on P2P lending as an income source to retire. Based on these factors and my experience with P2P lending over the past 6 years, I would not suggest relying on this asset class for retirement. This is especially valid if you consider retiring in 30 or more years. The industry needs to be more mature to predict its future reliably. There are still too many dishonest and greedy people who are not interested interested in creating sustainable investment opportunities for investors, and I don't think it will change anytime soon. As long as the regulators don't care and investors keep investing in black boxes, there is no incentive for the industry's players to change anything. If you plan to invest in P2P loans, you should not look at P2P lending as a whole, but rather evaluate individual platforms and the management behind them. There are a handful of platforms that do provide attractive investment opportunities that you should consider. I know how important it is to diversify, but it does not apply to the P2P lending industry. Here I argue that diversification across P2P lending platforms actually increases your risk. Over the past 6 years, I've tested about 50 platforms myself, and if you look at my portfolio update, you notice that most of my investments in P2P loans are spread across 3 to 4 platforms. Your retirement investment plan should be safe. At the end of the day, you hope to enjoy life when you get old. Planning to live off the interest from your P2P lending portfolio forever is too risky. And most of you agree based on our recent YouTube poll. There is a lot of value in P2P loans with an investment period of 1 to 5 years. This is a much more reliable time frame to consider. Our P2P lending calculator will also give you a more precise results over a shorter period. Anything over 5 years should be considered speculation. That being said, I don't think you should not exploit P2P lending when it fits your investment strategy. Being able to receive relatively passive income with little to no hassle is something that cannot be said about other asset classes. You can use P2P lending to store cash until you can invest elsewhere. You may be thinking about buying a property and renting it out. P2P lending can be a great tool that helps you achieve that, and that's just one practical use case where transparent P2P lending platforms might be worth considering. Thinking that P2P lending will be around in 30 years in the same form as it is today is foolish. Being aware of the risks and the environment that impacts the return on your investment is much more valuable than believing the narrative of not doing anything and earning passive income forever. Make sure that you are adequately diversified, invest in your knowledge, business, properties, and double down on what you think is the most sustainable investment in the long run. Investing is the keyword here. Just saving money in your bank account won't help you, as this will be largely eaten up by the inflation, which you can calculate with our inflation calculator on P2P Empire. That's it from me today. Let me know in the comments below for which purpose you use P2P lending and whether you think it suits your retirement plan. If you found this video helpful, do me a favor and hit the like button and subscribe to not miss out on future videos. Thanks for watching, and I'll catch you in the next one.